We are live. We bolt from the AUA-based model.
Thanks, Navin. Hi, good evening, ladies and gentlemen. Welcome to yet another webinar of MeritorQ Advisory Portfolio. I am Alok Nangalia and I'm part of the Client Advisory and Relationships team. I have with me Krishnan, who heads the research function for our quant offering, MeritorQ. The agenda for today's session is to understand the risks that come with owning a single stock or a very small set of stocks. Historically, investors often end up holding a single stock or small portfolio with a narrow set of stocks based on stock-specific stories or just looking at the recent market returns. Our analysis shows that such an approach most likely will result in disappointment. So in this webinar, we will try and understand that why is it difficult to beat benchmark indices with a narrow set of stocks and discuss various options available to buy and hold investor given the historical success rate and drawdowns of BSE 500 stocks. As usual, once Krishnan completes the presentation, we will have the Q&A session. You can type in your questions in the box on your screen during the course of the webinar, and we will try and answer as many as possible. I will also request Krishnan to take us the portfolio update basis the last rebalancing that we did in October first week. So with this, I request Krishnan to take the floor and take us through the details. Over to you, Krishnan.
Thank you, Alok. A very good evening to all the listeners. Before we kick off today's webinar, please note that investment in securities are subject to market risk. You should read all scheme-related documents properly before investing, and all the return figures, which we will discuss today, or which are shown on any of the subsequent slides, are for illustration and understanding only, and do not guarantee any future returns. So with that, I'll just quickly, discuss, the portfolio, what the new rebalanced portfolio looks like. So, this was the second rebalancing, which was, again reflected for MeritorQ. This rebalancing happened on October 3rd. That is last month. If you remember, again, this was per the rules in MeritorQ. So the strategy is rebalanced twice in a year as of the first trading date of April and October, right? And this, again, just following these rules, this rebalancing was effected again on October 3rd, 2023. So what you see on the slide is just summarized what the new portfolio looks like in terms of number of stocks. So that's again the new portfolio stats are the middle column on the table on this slide. So roughly the portfolio after rebalancing has around 38 stocks compared to 32 stocks in the previous portfolio. The allocation to the top 5 stocks comes to around 32%, and the top 10 it's around 51.5%. When you compare it when you compare it to the previous portfolio, this is a bigger portfolio, but at the same time, the concentration in the top 5 or the top 10 stocks has come down, right? Which is one of the key objectives of why we do rebalancing in the first place. In terms of some of the other portfolio stats, when you look at, for example, the profitability of the companies in the portfolio, the weighted average return on capital employed, we have taken the actual portfolio weights to calculate these ratio, the weighted average ratio numbers. It comes to around 26.6%, and the ROE or the return on equity comes to 19.9%. So higher these numbers, the more profitable or more quality the portfolio, the higher is the quality or the profitability of the underlying companies in the portfolio. When you look at it in terms of the valuation numbers, so earnings yield, for example, is the inverse of price to earnings. So higher the earnings yield, better, more cheaper, stocks you have in the portfolio. Similarly, free cash flow yield is the inverse of your price to free cash flow, which is what we use for selecting stocks in MeritorQ. And again, higher this number, better. So what you can see is the earnings yield for MeritorQ after rebalancing is 4%. Free cash flow yield is around 2.9%, both of which are better than the BSE 500 benchmark. right? Again, which again emphasize the value orientation of this portfolio. What we have seen is there are more higher quality stocks in this portfolio, so there is more of a quality bent in this portfolio. So that's why you would see a a higher ROCE, ROE, and dividend yield is again higher than that, or slightly higher than that of the benchmark, right? So that's what the portfolio looks like in terms of the distribution. When you look at the distribution in terms of sectors, again evenly distributed more or less. The allocation, there is some reduced allocation towards consumer staples, and again remember that we don't have any constraints on allocating towards a particular sector per the methodology. But again, this is the sector allocation, etc. What you see is incidental, depending on the kind of companies when you follow the rules, and this is what is shown here, right? The allocation towards financials continues to be low, and again, this is just following the rules. And again, we don't have a call on that we want a certain allocation towards financials or a particular sector. The large mid cap and small cap allocations again that you can see in the the chart or the table the bottom on the slide, and what you see here is again compared to at least the previous portfolio, there is more allocation towards large and mid caps, right? And if you compare it to the benchmark, we are slightly almost on par with an equal weighted BSE 500 allocations when you see on small caps, but we are overweight large and large caps when you compare with the benchmark, with the current portfolio allocations, right? So slightly overweight large caps versus the benchmark, slightly underweight mid caps when compared to the benchmark, but comparable to the benchmark when it comes to the small cap allocations. Again, like I said, the allocations here, whatever you see is the result of the portfolio construction process. We don't have any constraint either on large, mid, and small cap allocations. These are all the sector, right? So please keep that in mind. And also the large, mid, and small cap labels are again, they are basically based on whether these companies in the portfolio are members of BSE 100, the BSE 150 mid cap index, or the BSE 250 small cap index, right? So again, that's how the large, mid, and small cap categorizations have been done here, right? So again, what we wanted to emphasize with these two slides is the rebalancing has helped us achieve the three objectives which we have discussed in the past, right? Which is one of the reasons we do rebalancing in the first place, which is number one, pick undervalued stocks. So you can see that the free cash flow yield of this portfolio is higher than that of the benchmark, right? Or the price to free cash flow is lower than that of the benchmark in some ways. Secondly, it has helped you to reflect the change in the fundamentals. That is, we have reflected the change in the financial positions of these companies because we have the updated annual report, the FY 23 annual report of nearly all these companies, the financials, their financial condition of all these companies, which has been reflected in all the ratios, all the metrics that we calculate, and in turn in the portfolio construction process. And thirdly, rebalancing has also allowed us to reduce the concentration, in terms of portfolio allocations, right? So these were the three central objectives, for which we laid out, when we said, why rebalancing is required in MeritorQ. And what we are showing is again, when we do this rebalancing, you can see all these three, objectives, are somewhat achieved. So with that, again, just a quick update on the portfolio, the rebalanced portfolio. I'll just jump to this the topic of discussion for today's webinar. So again, to what Alok mentioned, right? This is a important topic, right? Because we frequently find investors coming to us, and they have, for example, they've invested a couple of stocks, either basis tips from friends or something that they've heard about from different people, and typically they want to know more about that stock, right? So this generally tends to be the scenario, And so as a result, uninitiated investors, especially people who are starting out in the stock market, they don't know a lot about these companies, but they've essentially bought small positions or in one or two stocks, and they eventually they end up putting nearly all their money in that one or two stocks, right? And or a very narrow portfolio, right? So what we are going to discuss today is very relevant for such investors, right? And what we will show you is our analysis tells us, right, again based on our research, that this is a very unwise strategy for all investors, right? And something that investors should keep in mind when they build or when they invest in a very narrow set of stocks, right? So what we have done is we present our analysis based on odds of performance and drawdowns for investing in a single stock, right? Pick from again the BSE 500 index, which is which, as you know, is the has the 500 largest stocks in India. And what we will do is we will show you the success rates of investing in these two in this top 500 stocks. If you just pick one stock randomly from this top 500 stocks, we'll delve into reasons, right? Why these numbers are why they look like the success rate are what they are, and we'll also discuss some key takeaways from investors. So firstly, just starting out with this table, right? What this table is showing you is the probability or the odds of a single stock delivering positive returns, which is the first column. The second column shows you the probability of outperforming a 3-month treasury bill, the Indian government treasury bills. This is the most simple or easiest risk-free instrument that you can think of, because essentially your risk of investing in a treasury bill is basically the sovereign risk, right? That the Indian government will default, which is the probability of which is nearly close to zero, because the government also prints money, right? So again, that's the second column. Third, the third column shows you what is the percentage of stocks again outperforming a market cap weighted benchmark, which is in this case is BSE 500, right? Again, we have shown this over different horizons, right? So if you take a rolling 1 month, what does it look like? If you look at rolling 3 months, what does it look like, right? And so on and so forth, 1 year, 5 year, 10 year. And then lifetime is basically from September 2002 to September 2023, right? So this is for a almost a 21-year period, which we are looking at in the last row, right? And again, our analysis is restricted here and nearly in all the other subsequent slides to BSE 500. Remember, because at least it forms the the most readily investable and liquid investment opportunities set for most Indian investors. And furthermore, also keep in mind that the odds or whatever the percentage of stocks we are showing, the returns have been calculated as total returns, right? So these the returns have been calculated including reinvestment of dividends, and they do not assume any rebalancing, right? So when I say rolling 10-year returns, I'm not assuming any rebalancing over this 10-year period, right? So no rebalancing has been assumed, and all the returns which we will be talking about in this slide and subsequent slides are total returns. Just to be clear on what we are trying to do here. And the reason why we have taken total returns is this is a more comparable metric for dividend paying as well as non-dividend paying stocks, right? So that's a simple reason why we are looking at odds or success rate based on total returns versus the treasury bills or versus a market cap weighted benchmark, or whether the returns are positive or not, right? So when you look at this table, the first takeaway, right, is that majority of the stocks deliver positive returns, right? And majority of the stocks beat the 3-month treasury bill over most of the investment horizon, whether you take 1 month, 3 month, 1 year, 5 year, 10 year, or even from 2002 to 2023. Most of the stocks they deliver they beat either the treasury bills or they deliver positive returns, right? And in both cases, the percentage of such stock increases as your time horizon increases, right? So as you go from top to bottom, the percentage of stocks which are either delivering positive returns or which are beating the 3-month treasury bill both of them, they keep on increasing, right? So this is basically the outcome of investing in equities, right? And one of the reasons we keep on saying that again, you should have a long investment horizon when investing in equities, because, and this is precisely the reason, right? So as your investment horizon increases, what this tells you is, typically in equities, your rate of, your probability of, compounding your wealth or growing your wealth, that keeps on increasing. And it allows you to compound your returns at a positive rate on an average. And this compounding is at least better than a 3-month treasury bill, which is your fixed income or your debt instrument, right? A risk-free debt instrument, right? So no questions there, right? The second takeaway is, and this relates to again to the last column, is that most of the stocks, they underperform the market cap weighted BSE 500 index, right? From which they are drawn in the first place, right? So all this analysis is again based on stocks taken from BSE 500, right? And we are comparing then the returns of each of these stocks over one month period, 3 month, 1 year, 5 year, 10 year, versus the market cap weighted BSE 500 itself, right? And what you find there is very surprising, right? The percentage of stocks, only around 35 to 40% of stocks are of BSE 500 index, they are outperforming the the market cap weighted benchmark. So majority of the stocks underperform the benchmark, right? So this is the key takeaway, right? And the percentage of stocks that outperform the index decreases with the investment horizon, right? So again, very surprising, right? So as you increase your investment horizon, more stocks, right, underperform than not, versus the market cap weighted benchmark, right? There are a couple of reasons for this. The first reason is because the benchmark by definition contains all stocks, right? So because it's BSE 500, it contains all stocks. So it is exposed to the similar equity risk, right, as well as returns for a single stock. Further, the benchmark, again, because it contains all stocks, it contains both the underperformers as well as the outperforming stocks, right? So, but what happens is the outperforming stocks tend to pull the average return upwards, right? And this effect is more powerful with the longer the investment horizon, essentially the compounding kicking in, right? So good companies, they keep on compounding their returns, and it keeps on adding up over a longer investment horizon. So if you keep the stocks for maybe 5 years, say in this case, what we are showing you is roughly 34.8%, 38.6% will outperform the benchmark. But if you keep the stocks for another 5 years, so when you look at the rolling 10 years row, what that tells you is that odds or the success rate of you beating the benchmark, the percentage of stocks beating the benchmark, that comes down to 34.8%, right? The simple reason is the stocks which are really good, they keep on outperforming, they keep on compounding, whereas the losers, they underperform, right? So the difference between winners and losers, that becomes starker, right, as the investment horizon increases. And since another reason also is the benchmark is a managed index member, in this case the 500 largest listed stocks in India, and because it's a managed index, underperforming stocks, very large underperformers, generally these tend to be small caps, they will eventually be removed at some point, right? This is going to happen because the market cap will keep on shrinking to the point that the company is no longer even a small cap, it becomes a micro cap. So it will be removed. Whereas because we are looking at these returns for individual stocks for a buy and hold investor, the investor is still holding these micro cap stocks, right? So that could also be the reason why you see this underperformance with respect to the benchmark, and the underperformance actually increasing as you increase your investment horizon, versus outperformance versus either the risk-free treasury bills, or when you just look at percentage of stocks delivering positive returns. So this the slide again, the previous slide we were looking at averages, right? So again, when you're looking at rolling numbers, we just averaged all these numbers between September 2002 to September 2023. What this chart again shows is just a time series of the percentage of BSE 500 stocks outperforming the 3-month India government treasury bills on a 10-year rolling returns basis, right? So again, we have shown the full time series, which we have actually averaged over to show the numbers, one of the numbers in the previous slide. So for example, the last value of 71.5%, which you see on the slide, means that roughly 71.5% of stocks within BSE 500, or roughly around 350 odd stocks, which were part of the index in September 2013, outperformed the treasury bills over the subsequent 10 years, right? And over a subsequent 10-year period from September 2013 to September 2023, right? Which is the last roll, 10-year roll as such, right? And when you take an average, this number from September 2002, this number comes to around 53.6, which you see with that dotted line, which is what we have shown as a 10-year average, again, for the treasury bill return column for the 10-year row in the previous slide, which we discussed, right? So again, what this tells you is, we have taken averages. We have, what we discussed in the previous slide. So previous slide was averages over, again, all those rolling returns. This slide again lays, again, the lays down in terms of the actual time series of these rolls, right? And this number does keep on fluctuating, but more or less you can see the averages, over a longer period of time, it just makes sense, right? So roughly 53% or 53.6% of your stocks in BSE 500, do slightly better than the treasury bill. So roughly half of the stocks, only around roughly half of the stocks do slightly better than the treasury bill, right? Which is also again surprising, right? Because if you hear the returns in the stock market, because to think about the returns when people talk about stock market, generally because it's a higher risk investment, you expect higher returns than a debt instrument, right? But what this is telling you is on a 10-year basis, which is a long enough investment horizon for most investors, most of the stocks in BSE 500, right? So if you're holding a random stock, not most of the stocks, nearly half of the stocks in BSE 500, would have underperformed even a 3-month treasury bill, right? So again, let's try to understand why this is happening and what are the things we can learn from this. So so the previous table, we looked at the average odds and then we looked at the time series. What we have done is, again, in this slide, we have tried to break it up, right, in terms of just one period, right? Let's take it from September 2006 to September 2023. Again, this period was randomly taken, right? So this is, again, this covers the returns or the backtest period, which we usually discuss in MeritorQ. So again, you can take any period if you want. I'm sure the conclusions won't change. So just focusing on the chart on the left, that again we are showing the distribution of these returns, again, of individual stocks in BSE 500 between September 2006 to September 2023. One can again see that this distribution is very unbalanced. Why? Because stocks which have delivered less than negative return of 80%, that's the biggest bar, right? Which is the very first bar, right? So again, each of those bars represent the number of stocks, right? Which have delivered that return in each of those buckets, which you see, right? And as you go from left to right, the stock returns increases, obviously, right? And we are just looking at cumulative returns over this 15-year or so period, 16-year period, right? And the red line basically is a cumulative percentage of stocks, right? So as you go from left to right, obviously, because you're covering the entire BSE 500, right? Essentially all the stocks which were part of BSE 500 in September 2006, that red line creeps up towards 100%, right? So the what that chart is trying to show is, again, it's a very unbalanced distribution, and while on an average, when you look at that distribution, the average is around 282%, right, cumulative return over and above what the BSE 500 returns has been. An average company, right, which is the median, as so as to speak, fails to beat this benchmark, right? So most of the companies again fail to beat the benchmark because the excess return is negative, right? The left chart also shows that around 64.5% and 43% of companies underperform the BSE 500 total return and the 3-month treasury bills respectively, again over this 16-year period. Please note that, again, from 2006, right, BSE 500 and 3-month treasury bill returns, if you just do the math, they have delivered annual growth rates of roughly around 12.3% and 6.5% respectively, right? So the chart on the right, again, the chart on the left shows this, all these stats over a 16-year period. The chart on the right, again, we have shown you're showing the same thing, but over a 10-year period now, right? From September 2013 to September 2023. And over this period, what you see is roughly 55% and 28% of firms have beaten have underperformed the BSE 500 and the 3-month treasury bills respectively. And again, over this period, BSE 500 and 3-month treasury bills delivered annualized returns of 16% and around 6% again over this 10-year period, right? And this again is, again, what we have discussed till now, right? The fact that the overall stock market represented by the benchmark generates healthy long-term returns, right? So when you look at BSE 500, last 10 years, returns have been around 16%, right? But most of the stocks in BSE 500 itself have failed to beat the benchmark, right? Have failed to generate 16%, right? Which is, sometimes, investors are not able to understand this, right? And like I discussed in the previous slide, nearly half the individual stocks from BSE 500 even failed to match the returns of treasury bills, which is a debt instrument, right? And all this can be attributed to the, again, like I said, because of this unbalanced distribution, you can also call it a skewed distribution. It's positively skewed, i.e., the mean of the returns of all the stocks, right, is more than the returns of the average stock or the median, right, which means the distribution is positively skewed. And this happens because the large positive returns of a few stocks in BSE 500, the multi-baggers, right, they offset the modest or negative returns of most of the other stocks or the more typical stocks within the index, right? So this is the reason why we see this, very unbalanced and skewed distribution, which, kind of leads to this very surprising outcome or, the conclusion, which we have discussed till now. Okay, and again, what maybe we have discussed on the last two slides, in terms of distribution of returns, the skewness, etc. Can be understood, maybe with a simple, example from cricket, right? In fact, I took this example from, one of the matches I saw in the most recently concluded World Cup. And this was the World Cup match between Bangladesh and South Africa. So this was played on 24th October 2023, and South Africa won this match by 149 runs. Right. In this match, the one thing that struck me was Bangladesh scored a total of 233 runs. So they lost by 149, but batting second, they reached around 233 runs, right? And it was actually 216 runs which they had actually scored, which if you exclude extras. But if you look at the distribution or the contribution from the individual batsmen or the players in Bangladesh, it's a fairly interesting picture which emerges, right? So there is just one batsman, Mohammedullah, who by himself contributed 111 runs to this total, right? Whereas the rest of the team members could barely score in low double digits, right? And because Bangladesh was chasing and they were all out, right? So it was 233 all out. We can actually calculate the average runs per player, which if you just divide 233 runs by say 11 players, you will roughly get around say 20 runs per player, right? Now, but when you look at the median run scored per player, or the run scored by the average player in the team, it comes to around 11 runs, right? Why? Again, this is because of that skewness which I talked about, where just one player in this case has contributed the most to the overall total, right? And because of this chasm between the highest run scorer and other players was so deep and wide, right? 111 runs, and you can see this distribution which we have shown in terms of the contribution in terms of runs in the chart on the top, that in terms of the bar chart. It was so wide that the highest scorer the runs from scored by the highest scorer, in this case Mohammedullah, pulled the average way ahead, right? Average run scored per player way ahead of the median number or the run scored by the average player, right? So this is something very similar to what we have seen in the discussion in the past few slides, right? So if you just substitute players for stocks, I'm assuming you at least are able to get a hang of the idea. So, again, if you again do a thought exercise, right? So, forget again about cricket or stock market, etc. Just a very simple thought exercise where so this is what we are trying to show here. So, what we have done is, if you assume just a scenario where you just take one stock and assume that the stock has an equal chance of going up either 20% or going down 20%, right, in any given month, right? The simple scenario, you just take one stock and you assume that the stock can either go up 20% with a 50% probability, or it can go down 20% or minus 20% return over 1 month with a 50% probability, right? So, and this model, by the way, even though it sounds simple, it's actually very close to reality, because when you think about stock returns over, a single day or a 1 week or even 1 month, it's a well-known fact that, returns over, very short periods of time in stock market tends to be random for most parts, right? So it's not completely wrong to assume a equal probability of going up and down. So average return is 0, right? So assuming that returns, in any period are not dependent on your past returns, that is, they are independent. If you extend this analysis to the next month, right? So 1 month, you started out, so that's a 20%. The stock is up 20% with a 50% probability, and it's down 20% with a 50% probability. Now again, you take it to the next month. So again, when you take it to the next month, you'll have 3 branches, right? One is, expected return of 44% with a 25% probability, expected return of minus 4%, right? And this can be due to 2 scenarios. Either the stock goes up 20% and again goes down 20% in the next month, or it goes down 20% in the next month, the first month, and goes up 20% in the subsequent month, right? So minus 4% due to 2 scenarios, so 50% probability of occurrence, right? And similarly, expected return of minus 35% with a 25% probability of occurrence. And this is what we are trying to show in the left graphic in this slide. So on an average, right, when you look at the returns over 2 months, you can still see that the average returns are 0, right? Your average returns, if you just just take the average returns, you just calculate the average returns, you will get an average returns of 0% over a 2-month horizon, which was the average return even over a one month horizon, right? But the median returns, right, or the returns which you can expect more often, right, is minus 4%, right, which has a 50% probability in this case. So what this tells you is, even though you assumed a very simplistic case, right, even over 2 months, what happens is, even if over 1 month there is no skewness in the returns, so average and medians are exactly the same, just because you're compounding, these returns are compounding for any stock over a 2-month period, and if you extend this to 3, 4, 5, 6-month period, this compounding of returns can cause this skewness, right? And which is what you see, what we have discussed in the previous slides, which causes the mean of the returns or the average of the returns to be more than the returns of the average stock, right? Scenario 2, again on the right, again shows a case where mean of the returns over 2 months is lesser than the median, though it's a less probable case. We will not delve into the detail here. Another way to think about this effect, again, this skewness, etc., is to keep in mind that, for any stock, right, remember that the returns can never go down below minus 100%. Why? Because share price can never be negative, right? They can, at the most, they can go down to 0, right? While on the upside, your returns can, go up indefinitely, right? They can go up to as high as possible, right? Which also causes this the skewness, right, which you see, where a few outperformers drive the returns of the entire stock market, right? So compounding of successive random returns induces skewness in the return distribution across stocks, causing the returns of the average stock to be less than the average across all the stocks, and this effect becomes more pronounced over longer horizons, and in effect, if an investor buys stocks randomly without much research, right, which is what we started out with, and simply, just sits on this portfolio, then the longer the time passes, right, the lower is the probability, that this investor will be able to beat the market, right, the market cap weighted benchmark, right. Another cricketing analogy which you can take it, if BCCI, right, were to randomly pick players from Maidans of Mumbai, right, and insert them into the Indian cricket team, then the longer the passage of time, the more this random cricketers picked from these Maidans will drag down the performance of the Indian cricket team, and it is more unlikely that any of them will turn out to be a Virat Kohli, and or that particular team will ever go on to win the World Cup for India, right? Again, just in terms of a cricketing analogy to complete our understanding of what we discussed, right? Now we have looked at the odds of outperforming. We have looked at in terms of returns. What happens, if we look at the risk aspect, right? Large drawdowns or, the sharp reduction value of your investment can be painful for any investor, right? Large drawdown when accompanied with permanent loss of capital, right? So, drawdown happens for a stock and you lose all your wealth and the stock never recovers, right? That is in fact a real risk for any long-term investor, right? Because you lose your capital, invested capital. There's no chance that, of recovering that capital or it, coming back to you. Therefore, in this slide, what we are showing is this odds of experiencing this drawdowns of different magnitudes for a single stock, right? So what this chart is showing you is the number and the cumulative percentage of stock that witnessed maximum drawdown. That is, the maximum percentage they fell, the maximum percentage fall in share price from the peak to the trough, right, over multiple time frames, right? So you've chosen two time frames. One is from September 2003 to September 2013, which is shown in the with the blue bars, and another period from September 13 to September 2023, which is again a 10-year period, which is shown with red bars. The reason we have shown two periods is because it covers the two major drawdowns over the last 20 odd years, which we have seen, right? One is the first period, it covers the global financial crisis drawdown, which happened in 2008-2009, and whereas the second 10-year period, it covers the corona drawdown, which happened in March 2020, right? So in a way, this covers the two major drawdown periods. And what we have done is just bucketed this drawdowns stocks, into 8 equal buckets, right, on the x-axis. And we have also shown what was the average drawdown experience by each of the buckets in each of this the buckets which we have shown. So what you see here is, again, very unbalanced distribution. And the most surprising, result is more than 70% of stocks in BSE 500 have experienced drawdown of more than 50% over a 10-year period, right? So this seems to be the the case even when you look at the 10-year period from 2003 to 2013 or from 2013 to 2023, right? And a drawdown of more than 75% over a 10-year period is the most common occurrence for most of the stocks, right? So imagine you pick a stock from BSE 500, right? Or even if you pick 5 randomly chosen stocks, what if all of them incur a drawdown of 70% plus, right? God forbid, if all of them go through the drawdown, obviously I'm assuming it should not be that bad a case, but even if most of them incur a drawdown of more than 70% all at the same time, imagine the amount of financial as well as mental trauma investors in these very narrowly built stock portfolio have to go through, right? So so again, the point we are trying to make is again from a risk perspective, why is it risky, right, to hold just a small set of stocks or an already built portfolio without much research. Now, obviously, whatever we have discussed till now, the obvious question on your mind is, given that most of the stocks in BSE 500 underperform the benchmark, and index returns are driven by a few multi-baggers, the question would be, how do you identify the outperformers or the multi-baggers, right? Our analysis shows that the most identification is most effectively done by focusing on fundamentals, right? So what this chart shows is just emphasizing this point. What we have done is we have divided the whole BSE 500 to 10 equal size buckets, and we have each of the buckets basically represent the performance over rolling 10-year periods, right? So as you go from left to right, the buckets, the performance of each of the buckets or the returns delivered by each of the buckets increases, right? So the bucket or the bars which you see on the extreme left, those will have negative returns, right? And the one which you see on the extreme right, they have they are the multi-baggers essentially. And what you see is what you have tried to compare them with the EPS growth rate or the earnings per share growth rate, right? Which is represented by your, so the blue bars they represent the earnings per share growth rate. The red bars essentially show you the returns, right? And what you can see is every time the blue bar goes down, the red bar also goes down, and every time the blue bar goes up, the red bar also goes up, right? What this tells you is over a long enough period, right? Over a 10-year period, which is the recommended investment horizon in equities, prices or returns of investing in stock investing or equity investing, they follow fundamentals, right? And in this case, it's very clear, as apparent as it gets. So the best way investors can improve the odds is to focus on fundamentals, right? And to build and not focus on individual stock stories or build, again, very narrow portfolios, which is again what we've discussed before this. And again, if you think about, what we are doing in MeritorQ is precisely on these lines. We are focusing on fundamentals and we build a diversified portfolio, right? So, while our analysis, whatever we have discussed is for the Indian stock market, you can find similar studies, right, which have been done in other stock markets as well. So Indian stock markets are not unique in this regard, right? Whatever we have told you, that, most of the stocks actually underperform the benchmark. India is not an outlier. In fact, a similar study was done for US stock market, and it found that the best performing 4% of listed companies, 4% of listed companies in S&P 500, right, explain the entire gain of US stock market from 1926 to 2016, right? So the entire wealth created by stock markets, right, or in equities between 90-year period, right, 1926 to 2016 in US, can be explained by only 4% of listed equities, right? This number is in a similar ballpark for India as well, right? So it's in low single digits. And obviously, just to preempt some of the questions, we have restricted our analysis to the top 500 companies. Someone might ask, why didn't we consider micro caps or all listed companies in India? The simple reason is, again, like I said, right, BSE 500, at least to us, is the most investable or liquid opportunity set. And because it is also the investment universe in MeritorQ, so we have restricted analysis to this. But if you include micro caps, I'm absolutely sure that the odds which we have shown would look even worse, right? So whatever numbers we have shown will look even worse, or the rate of underperformance or the success ratio will look even more extreme when you consider the entire stock market, right? So the analysis presented in this, whatever we have discussed, shows why investing in a single stock or narrow set of stocks, will most likely result in disappointment, and it reinforces the need for portfolio diversification for most investors, assuming that you do not have any specialized skill for security selection or in forecasting, right? And remember that diversification also reduces the volatility, right, of portfolio returns. But again, like I said, diversification in this case, if you think about what we have discussed today, it reduces your chance of missing out on potential multi-baggers, right, which have potential to generate very large cumulative returns over extended periods of time, right? And in context of MeritorQ, remember that our steps in the portfolio construction process, where we screen out companies which are either manipulating their earnings, which are cyclical businesses, which have high leverage, and essentially these are key company characteristics, which helps us identify, basically avoid wealth destroyers and also identify companies, good companies, which will compound investors' wealth over long run, right? And again, like I said, the portfolio we are, in MeritorQ, we are holding, between 30 to 45 stocks. The current portfolio has around 38 stocks, which is, again, reasonably diversified, and we rebalance it twice in a year, again, further improving your chance of outperformance over a longer period of time. So if you have a demat account, you're better off holding a portfolio of stocks instead of just just investing in a single or one or two stocks or 5 or 6 high conviction bets. Investing in a conviction portfolio of less than 10 stocks requires considerable skill. Remember that, right? Considerable forecasting skills, and should definitely not be based on tips or rumors. And conviction and concentration can increase, with increase in forecasting skill. But unless you can reliably do this, right, you're better off holding a diversified portfolio. That is probably the best option available to layman or common investors. So with that, just conclude today's session. Hand it over to Alok.
Thanks, Christian. These are some really useful numbers that you have shared here. So in continuation to your last point, the first question that comes to my mind, in fact, it might be a question in a lot of our clients' minds as well. Marcellus has always advocated a concentrated portfolio of say 15, 20 stocks or max say 25 stocks. And we have always maintained that say 15 to 20 stocks should be good enough for diversification. Whereas your analyst suggesting that holding such a concentrated portfolio can lead to underperformance. So is my understanding correct, or am I missing out something here?
No, I mean, when I say a narrow set of stocks or a small portfolio, I'm referring to again a portfolio, very small portfolio of stocks. Again, very small set of stocks. Essentially, anything less than 10 stock portfolio, right? Which is not, which no one, which is very difficult to argue it is diversified in the first place. And secondly, like I said, right, it's maybe beyond 10 stocks, you can still argue that the portfolio is diversified, right? Assuming that you have been thoughtful about your portfolio construction, and assuming you have enough skill, right? So if you have enough skill, or if you can find a manager, right, or someone who has that conviction and the depth in their the research process, so they can afford to concentrate, or they can tell you very reliably that these 10 stocks or these 15 stocks will outperform or will be the biggest outperformers in the future, then it's okay, right? The point being that for most investors, it's very difficult to do by themselves, right? So if you are a common investor, right, or a layman investor, you're best off, in fact, by building a diversified portfolio, right, and which can obviously get rid of your all your underperformers at the same time, making sure that at least some of these multi-baggers are included, right, because you have a larger portfolio.
Got it. That clarifies. So next question is on your slide 6. It shows that percentage of BSE 500 of stocks outperforming versus the treasury bills, which has been improving lately. So are more percentage of stocks outperforming the index too? Is that related to the small cap rally that we have witnessed recently over the last, say, 6 to 12 months?
Yes. And in fact, this number, if you compare for the percentage of stocks which are beating BSE 500, this number is right now around 45%, right? And the average there over again this period, 10-year period, would be around 35. So 45% is where the number is today. So 45% of stocks over the last 10 years, would have beaten BSE 500 versus the 35% long-term average, right? So, and that is predominantly driven by this, mostly small caps doing well. And that's again no surprise, because small caps generally tend to be more numerous, right? So when you take BSE 500, like I said, I mean, 50% of your stocks in BSE 500 is basically small caps, right? In fact, if you take the top 300 or even 400 stocks, even include mid caps, roughly 80% of your stocks, right, 70 to 80% of your top 500 stocks are either small or mid caps. So if they do well, the percentage of stocks, which do well or which beat the benchmark, that also increases.
Right. So a follow-up question, which is also related to the current allocation of the portfolio. Our portfolio is still having higher allocation to small caps and mid caps, and some increase in large cap as compared to the last portfolio. But don't you think that because the valuation would be more favorable towards the large cap, we should have a higher allocation there?
Yeah, I mean, actually, the allocation towards large cap has increased, which is what you see here. So when you compare it, with respect to the equal weighted BSE 500, you have a higher allocation towards large caps, in fact. So the allocation towards large cap, I will argue, is higher. And even when you compare it to the last portfolio, which is based on the drifted weight, right? So this is the portfolio, the last rebalance portfolio based on weightages as of 30th September or 29th September in this case, right? So even when you compare to that, the allocation has increased from 23.9% to 28% odd, right? So, sorry. So I would argue that the allocation towards large cap has actually increased, but remember that again that this the whole portfolio construction process in MeritorQ, we don't have any allocation constraints, right? So even if there are while the small cap or the mid cap space on an aggregate might look very overvalued, right, to someone, there could still be pockets of opportunity where you could find good profitable businesses which are trading at a discount, right? Which we might be picking up. So all I'm saying is, it could be that small mid caps on an aggregate are very overvalued, but because we don't have any allocation constraints, we still have a meaningful allocation towards small and mid caps, right? And that's simply a result of the portfolio construction process.
Okay, got it. So there are a couple of questions like what will be a best, what is the best metrics to shortlist a stock, and why we have exited some of the stocks in the recent rebalancing. So I think it will be good if you can just quickly touch upon the factors which will influence the exit or addition of stocks in the portfolio.
Sure. So the biggest delta, which influences the exit or entry of stocks in MeritorQ is number one, the fundamentals. Fundamentals are generally, that don't change very rapidly, right? I think we have touched upon this a lot before. When you look at things like profitability or leverage, unless a company dramatically increases leverage or becomes unprofitable, generally that's not the case for entry or exit of any company, right? What does influence the turnover or the churn in the portfolio or the entry exit is the valuation bit, in which we use price to free cash flow, like we have said in the past. Now, like I said, right, free cash flow or price to free cash flow for us is the true north, right? Free cash flow is the most basic, element which goes into valuing any company, right? So the better the free cash flow generation ability of any company, the better it is. It's the long run value of that company, the most sustainable, you can argue, its businesses. Again, based on the other things we also check for, right? We look at free cash flows, just to emphasize, we look at free cash flows. These are basically earnings after working capital investments, after capital investments. So basically, this is the cash flow available to company to either redistribute to you as investors or available to be, invested back into the business, right? So again, like I said, higher the free cash flow, better off you are as investors holding that stock, right? So all we are doing is, when you're looking at a price to free cash flow metric, is looking at what is the gap between the current price of the company versus its free cash flow per share. And we buy companies where this gap is very very large, right? Essentially, the price is available at a discount to the free cash flow, right? So, and more is the discount, more will be the allocation. First of all, it will make it into the portfolio, right? And more will be the allocation to such a company, right? Again, it's if you think about the overall portfolio construct, what we are trying to do is we are trying to have a base minimum support in terms of quality, in terms of having make sure we are not picking value traps. At the same time, we make sure that once we have identified good quality companies out there where the fundamentals are sound, wherever we have opportunities, right, where we see this disconnect or this mispricing or this gap between price and free cash flow, and wherever that company is available at a discount with respect to its free cash flow, we are picking it up and including it in the portfolio. Right. At the same time, companies which have reached their free cash flow, again where the mean reversion has happened, where the price to free cash flow there is not that mispricing is no longer present, we get rid of that company, right? So exits would most likely be companies which have reached their fair value or their free cash flow generation potential, whereas entries would be companies or the fresh entries would be companies where this gap has opened up, right, or this mispricing has opened.
Got it. So one question on the portfolio after rebalancing. In fact, the portfolio prior to rebalancing also had a very low exposure to financials. So do you think there is some specific reason why the financials are not getting maybe shortlisted in this portfolio construct?
I mean, we have discussed this in the past. I mean, there is no bias towards financials as such, right? There is no bias towards any sector. This is what we do. We in fact use exactly the same process for all companies in BSE 500. So there is no constraint in terms of sector allocation. What happens is though, and I think what many people don't understand is when you're looking at financials, it's not just banks, it's not just lenders, right? There are financial services companies. We have a few financial services companies, again, if you think about the growth in India, it is going to come. If you think about any lender, which lenders are going to be part of it, but a lot of interesting fintechs, financial services businesses are out there which are available at a discount also, right? And at the right point, they will get. I'm sure they will be included in the portfolio. And also remember that financials, when you think about the sheer number of companies, right? So roughly in BSE 500, there are only 80 financial stocks, either financial services or lenders. So 80 stocks out of 500 would be, if you do the math, roughly it's less than 20%, right? So less than 20% in terms of that's their odds of selecting such stocks. And most likely because when I see this allocation, what this means is not a lot of stocks have cleared our initial filters, and maybe it's also true that we are also not able to find as undervalued opportunities in financials versus the non-financial space, right? But it like I said, there is no allocation constraint in terms of allocation or nothing we are doing when we are constructing the portfolio which discriminates against financials in whatever way.
Right. So there are a couple of general questions. First one is whether the size of the portfolio, the number of companies in the portfolio, has any relation to the age of the investor. I think it should be more related to the say risk reward expectation or the kind of expectations that an investor might have. What do you think about this?
Sorry, I couldn't understand that question.
So does the number of companies in the portfolio should depend on the age of the investor? Is there any correlation there?
Number of companies in the portfolio.
So I think,
so.
What the investor is trying to say is whether if he is young and he is willing to take more risk, whether he can have a concentrated portfolio, and as the age progresses, then whether he should diversify more.
I mean, you can argue, whether that's the right way, but it depends on your goals. But instead, a better way of doing this is having a higher equity allocation towards when you are young. In fact, putting nearly all your money in equities, essentially following the 100 minus your age thumb rule, right? as much as possible. And as you get older, maybe reduce your allocation, towards equities, which is the recommended, asset allocation which you would see. Instead of thinking about, whether we should, change from a high conviction to a diversified portfolio as depending on your age, right? Because look, the biggest risk either in a diversified or in a concentrated portfolio is equity risk still, right? But what investors should avoid at all costs is, especially when they're holding a small portfolio, is to, hold, first of all, very small portfolios or punting in stocks based on rumors and tips, right? It's like we have discussed in this webinar, that is, a very bad strategy, because your chance of, doing well over even a 5 or 10 year period is, it's, quite low, right? The odds are stacked against you. So that's something you should definitely not do.
Got it. I think we don't have any further questions. So before we close, I'll quickly reiterate that MeritorQ portfolio is a predefined portfolio available on small case, wherein you can subscribe and invest into this portfolio in less than 5-6 minutes. It's a complete online process. If you need more details, you can visit our website, www.marcellus.in/advisory, or you can drop in an email to help.ia@marcellus.in. In case if you're facing any execution related difficulties, you can write to help@smallcase.com, and they will be able to help you with your execution related queries. So before we close, Krishnan, do you have any closing comments?
No, I mean, we have discussed, I think we have given you a portfolio update on, what the current rebalance portfolio looks like. And we have, I think we have discussed a topic today, which is really relevant for a lot of investors, especially, given, the kind of questions we get frequently when we talk about MeritorQ. So I hope, we were able to explain, this, these conclusions and, give you some, some key takeaways for you to, when you think about your own investing approach, right? And hopefully that's helpful for you, as you think about, investing in equities.
Yeah, thanks, Krishnan. Now, if you can quickly display that disclaimer slide before we can close this. Yeah, thanks. So with this, we come to the close of today's webinar. We hope you were able to get some insights around why a portfolio approach will help an investor generate an optimum risk-adjusted returns, and why MeritorQ strategy offers this balance of good quality, profitable, and undervalued stocks to grow your wealth over long periods of time. As I mentioned earlier, if you have any further questions related to the products, please feel free to drop us a line on help.ia@marcellus.in, or visit our website, wherein you can find a lot of answers in the FAQ section. So thank you, sir, so much for attending today's session. Have a great evening. Thank you, Krishnan.
Thank you.